So I just want to talk about the Euree A-REIT Securities Fund, which is a fund that invests in listed property securities. So stocks like Scentre, Stockland, Mirvac, GPT, Charter Hall, and so on. And basically what we're endeavouring to do is to generate a return that is 1.5% above the index after fees over rolling 3-year periods. And historically in previous funds, one that ran for about 17 years, we achieved that on an ongoing basis, and in fact achieved the outperformance over 5 years, 10 years, and pretty close since inception. But we do things slightly differently in terms of our competitors and our peers. Why we're different is that we are a high conviction manager. We have a limit on the number of stocks that we can hold, which is 20, and a minimum of 10. So we must be invested between 10 and 20 stocks at all times. And the way we do things is that whilst the benchmark is the S&P ASX 300 A-REIT Accumulation Index, we, rather than mirroring the index, which has got about 31 stocks, we only invest in 20, can only invest in 20 maximum. So we're selective about which stocks we hold in there. But the way we do things is that if we don't like something about a stock relative to the index, we have a zero exposure. So it's not like we have an underweight. It's either in the portfolio or at zero. There's two exceptions. The two exceptions are to Goodman Group, which now is around 36% of the index. So we can be, and we generally are, underweight Goodman Group, even though it's the largest and probably one stock that is very popular with international investors, because its exposure is not only to the Australian market in terms of industrial assets, but also in the UK, in the US, and in Asia, Hong Kong and China in particular. So it is a global giant, as it were, and so we do hold it, but we can hold it at below the index weight. Now, what that does is for example, if something's got an index weighting of 5% and we don't like something about it, we'll have a zero exposure, and we can use that allocation to other stocks. And by other stocks, what we look for is some of the smaller stocks around in the sector that are not traditionally exposed to the traditional assets, our commercial, industrial, and retail. I mean, we've just had some words about rural funds, which is agricultural and is in our portfolio. Stocks that we think do provide growth prospects in other sectors. So we like retirement living, not aged care, but retirement living. We like childcare, and remember, both of those assets are actually in those businesses are government supported. So they are positive in the way that there is funding coming through from the government for them. So they're the sort of things we like. We also like some of the smaller, purer plays in retail, but we're not exposed heavily to the retail sector that in terms of spending habits. We're more exposed to those commercial assets, retail assets that provide services for everyday food. So stores like Woolworths and Coles, local shopping centres. So they're the sorts of things we like. We also are positive on the medical centre type assets, medical and hospital. It is a growing sector as far as property sector is concerned. So we do things differently. We have a set criteria, and we're not generally looking for yield on its own. What we do is it's a combination of total return. So we're looking for some growth in the asset price of what we're buying, as well as an ongoing yield that is relatively attractive. Now, the sector itself is probably yielding at the moment around 5.5% to 6%, but there are some offerings at the moment that are yielding 7s, 8s, and 9s, and we sort of weigh that up with the risk attaching to those specific sectors. There is one office stock which is yielding about 9.5%. Which is quite attractive, but we don't see at this stage a lot of upside in the price. So we don't just target yield for the sake of yield, but we look at a total return type exposure.
One of the sort of dominant features in the REIT sector this year has been M&A activity. There's been a number of M&As going on. What's driving this M&A, and do you think it will continue in the sector?
Well, because the sector is generally trading at such big discounts to their NTA, that's net tangible asset backing, there are obviously opportunities out there. The problem has been over the last 12 months, 18 months or so, is that the actual larger groups that are looking to acquire to take part in M&A activity don't have the cash, number one. And number two, because they're trading at big discounts, they can't raise capital, which would be very dilutive to their share price. So they're stuck, have been stuck. But we are seeing some activity now in M&A, and I think as we go over the course of this year, we'll see a lot more take place.
And over the course of obviously 23, interest rates were going up at a rapid pace. There's lots of debate or what's going to happen this year. It looks like inflation's under control. There won't be any more rate hikes. Maybe we'll get a rate cut. Have you seen any significant shifts in the REITs from funds? Have there been any particular trends that you've seen that versus last year into this year?
Well, there's been more of a concentration and focus into industrial type assets, in retail assets, and away from office, because office has been under a lot of pressure as a result of the working from home environment, and so people sort of need less space to accommodate the same number of people if a third or a quarter or even a half are working from home. So they don't need the amount of space. So the trend that we're seeing now is that tenants are looking for better quality space, but less of it than what they've had in the past.
Winston, as always, an absolute pleasure. Thanks for taking part today and talking about your fund.
It's a pleasure. Thank you very much.